Growing dividend investing is a popular strategy with many investors. It involves buying shares of companies that have a history of paying regular and growing dividends. Investors looking to diversify their portfolio, hedge against market declines and inflation, or generate passive income can look to growing dividend investments. Companies that offer this type of stock are often recognized for their stability, low volatility, and even positive future prospects. However, as with any investment, dividend growth stocks come with risks and considerations to keep in mind. In this video, we are going to see what a dividend is, how does growth dividend investing work, and how to calculate dividend growth ratio of a stock. We also gonna see different strategies for dividend growth investments and the difference between dividend yield and dividend growth. And finally, we are going to talk about the risks of growing dividend investing. So make sure to stay till the end of the video to be sure you don't miss any important information. I'll put in the description the time codes of all of the sections so you can directly go to the part you're interested in. But before we start, please take a moment to like this video and subscribe to the channel to support me and help me improve the content I am posting. What is a dividend? A dividend is a portion of a company's profits that is paid out to shareholders. It is usually conditional on the company finding a surplus or profit and is often paid at regular intervals, such as quarterly or annually. These dividends can be paid in cash through a dividend check or credit with the brokerage firm of your choice, or in the form of additional shares. If paid in cash, investors can reinvest it to buy other stocks or use that money elsewhere. How does growing dividend investing work? Growing dividend investing is a popular strategy with many investors. It involves buying shares of companies that have a history of paying regular and growing dividends. Another component is to use the payouts to reinvest in the company's stock or in the stock of other companies with a similar dividend history. The objective is the compound growth of the investment portfolio. Although dividend growth investments are generally recognized as having low volatility, no investment or payment of dividends is guaranteed. How to calculate the dividend growth rate? A stock's dividend growth rate is a percentage-based equation that tells investors how much that stock's dividends have grown over a given period. As a company grows, it may increase the dividends paid to investors, which can be a sign of stability. The dividend growth rate is calculated by dividing a stock's annual dividend for a given year by the previous year's annual dividend and then subtracting 1. For example, let's say a company's current annual dividend is $2.20 per share, but last year the company offered $2.05 per share. The dividend growth rate would be 7.3%. To find the dividend growth rate over a series of years, simply average the individual change in the dividend growth rate for each year in question. Dividend growth investment strategies. A dividend growth investing strategy can focus on the following: companies with a history of steady growth in dividend yield. Diversification into companies in different sectors, which limits the effect of a decline in one sector. Buy and hold, as the purpose of reinvesting dividends is to increase returns over time. Companies whose dividend yield growth is greater than, or at least equal to, the rate of inflation. Companies that earn their dividend and make payments from current earnings, not accrued capital or debt. Each investor will have their ideal approach based on their goals, financial situation, and risk tolerance. Dividend yield and dividend growth. A stock's dividend yield, on the other hand, can tell investors how much the company is offering in dividends relative to the stock's price. Yield and growth rate are both important to investors for different reasons. Yield shows how much a stock is currently paying in dividends relative to its price, while growth rate helps investors analyze how a company's dividends have changed over time. To calculate the dividend yield, simply divide the annual dividend paid by the stock price. For example, consider a stock that is priced at $54.50 and offered a dividend of $2.20 per share last year. In this case, the annual dividend yield would be 4.04%. I already made a video in this channel where I talk about high-yield dividend stocks. How to invest in dividend-growing stocks. Finding dividend growth stocks involves analyzing stable companies with a history of growth and calculating, or finding, their dividend growth rate. The Dividend Aristocrats Index, which tracks companies that have offered growing dividends for the past 25 consecutive years, is a useful resource for examining dividend-paying stocks with growth potential. According to the index, its constituent companies have proven they can weather housing bubbles, economic downturns, recessions, financial crises, volatility, and even pandemics unscathed. The risks of growing dividend investing. Of course, no investment strategy is without risk, including investing in dividend growth. Nothing is guaranteed. Nothing says dividends won't be cut in the future or stock prices won't fall. If investors chose to reinvest dividends and buy additional shares, rather than put that passive income to use elsewhere, the impact of an unexpected and drastic drop in stock prices could be magnified. Dividend-growing investments are long-term investments. For investors looking to recognize significant growth in a short period of time, dividend growth stocks may not be suitable. Dividend growth investments are generally popular with long-term investors. In conclusion, I would say that investing in growth dividends is inherently a long-term investment strategy. It takes time to work because the goal is consistency, not quick profits. The added benefit of dividend reinvestment also takes time to show results. Of course, investing in dividend growth is not without risk. Companies whose dividends have been rising steadily for a long time may run into trouble and reduce their payouts. Here we are at the end of this video. I hope you really liked it and you found it helpful. Make sure to hit the like button and subscribe to the channel to stay updated when I post a new video.